Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
Hello, everybody. This is Coach D with TackleTrading.com, here to give you a quick market update and recap. And we talked considerably about the broad markets in our coaches show today. So if you haven't had a chance, if you weren't in attendance and you would like to get a really in-depth overview of what's going on with the market, economics, commodities, et cetera, definitely check out the coaches show this week. It's phenomenal rendition, all coaches there, and definitely we enjoy having you there. So for those of you who were there, awesome. For those of you who haven't had a chance to catch it, make sure you watch for the recap. So here's what I'm seeing in the general market is the S&P is down for the second day in a row, and we're trading into that triangle trend zone. And overall, I'd say it's trading. We kind of got this little overhead resistance, which I talked about in the stock report. And I mentioned that I was relatively cautiously bullish, tentatively bullish across the board on everything. So the market being down for a couple of days. Not necessarily contrary to the expectation, because it hasn't violated trend, and if it does end up breaking the support zone, that would start to change sentiment pretty quick. But I wanted to show you real quick here how to use the seasonality tool. And one of the things that we again do in the 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 stock report every week is, let's go look at our stock report and just talk about that little seasonality section at the top of the stock report. And this week I put out quite a few more picks and kind of gave the overall seasonal outlook, which we do just by focusing on this seasonal 20-year seasonal average by month. And you'll notice that there's this little lull, pullback in middle of December right here. And so, this is the Santa Claus rally that they oftentimes talk about. This is, again, 20 years of historical S&P data. So, you can take that chart, but you can also look at every sector by season. And we can drop back in here, and I wanted to show you again in Thinkorswim, one of the tools you can use is you can go to your chart, and you can go up to where it says Style, and click on the Style, and come down to where it says Chart Mode, and change it to seasonality, and then it'll load up two bits of data. Now the blue line is the current values, the red line is the historical values, and it's tracking quite a bit of old data, so you'll get that data down here. You can kind of look at it seasonally. We're looking at a little bit of a dip before that Santa Claus rally, is kind of how that market movement goes historically. So you can do that. Now the average that we're currently tracking is based off of a year. We'd need to go in here and change it to get this to history we want. We need to go 20 years, and if we can still hit a daily time frame on that, and that's going to change that average around a bit. So now we've got 20 years worth of data, which I again consider the modern market era. And then to zoom in on that, to kind of understand it, you can actually go in, and you need to be on manual to be able to zoom in on this, and then you can just highlight the seasonal portion of that, and you can kind of look at it from where we are here. And this is that pullback, and then the seasonal Santa Claus rally. So, when the rally starts, again, remember this is an average based off of 20 years, and it can start sooner. This year, the October rally started sooner than in past years. So this would be, again, kind of an indication, and the market is kind of poised for a general potential, general consolidation. Now, the problem is we don't know. When you look at a consolidation, you don't know which way it's going to go. It can break either way, and they do need to break. And actually, one of the things we talked a little bit about in this week's Coaches Show was Fibonacci's, and we talked a little bit about how they work, how we're believers in them. And one of the interesting things about symmetrical triangles is that they will usually go through a little Elliott wave count of their own. So, back here, for example, there's a symmetrical triangle, and it'll go through a little, cycle where it goes through, 1, 2, 3, 4, 5 before it usually takes a directional break, and you'll see that it goes through a 5 to 8 wave count. So 1, 2, 3, 4. Let's zoom in on that and kind of get a little bit closer look at it here. So it typically goes through 5 wave cycles. So you go 1, 2, 3, 4, 5, and then it picks a direction or down. We don't know which way it's going to go, or sometimes the wave counts can be consolidated a little bit more, and it certainly can. There's a lot of overhead resistance we've talked about, but consolidation in general, it's like pinching down a spring, and it releases a lot of energy. And so if it does break to the upside, we can be cautiously bullish, but I would want to do it in things like the tech sector where there is no overhead resistance. If we drop out and you go look at the NQ, the NASDAQ, for example here, it's already cleared the overhead resistance. And if we go look at some history here, if we're now looking back at, let's drop into, say, 20-year weekly chart, you can see we're trading at all-time highs. So there is a clean air overhead, no old resistance. Whereas the S&P and the Dow, let's look at the Dow, it has overhead resistance, like major benchmark highs from earlier this year. And the Russell 2000 has been one of the challenge. The mid caps have been underperforming, and they're kind of in that kiss goodbye setup scenario still, where they have significant overhead resistance, and you've got a bit of a bear forming head and shoulders, maybe kind of a bear pennant in here on the weekly time frame. And if we drop that into daily, you'll see that it's crossed the channel and it's range down into the trend zone, and showing some candle signals for potential reversal. We could get some life into that, but I'd say it's going to be kind of contingent on which way the major market indices go. This time of year, we only have a couple days left before the volume gets really, really thin between the holidays. So between Christmas and New Year's, trading volume really dies down and market movement gets super quiet. And so we've got kind of the last couple of days before the Christmas season really starts, and people's attention really turns away from the markets. And then it's going to reset. Typically going into the first trading days of the year, the market picks directions, and so you watch that. And something to keep an eye out for in the near future is the January barometer, where we watch the way the market closes in January to gauge sentiment for the overall year. So this is Coach D with TackleTrading.com. We look forward to seeing you in the clubhouse, and definitely, if you get a chance, watch the Coach's Show recap.